This week, we heard details about more trillions in spending and even changing monetary issuance laws around the world.
Good evening, my fellow Americans. Tonight, I'll lay out my first step, the American Rescue Plan that will tackle the pandemic and get direct financial assistance and relief to Americans who need it the most. Next month, my first appearance before a joint session of Congress, I will lay out my Build Back Better recovery plan. Infrastructure, manufacturing, innovation, research and development, and clean energy. Investments in a caregiving economy and skills and training needed by our workers to be able to compete and win in the global economy of the coming year.
The International Monetary Fund, what critics might call a supranational leveraged buyout bank, was out this week making calls for governments worldwide to spend as much as they can. Also, the IMF noted that monetary issuance laws will need to be changed in over 100 nations in order to bring direct issued fiat central bank digital currency, or CBDC, to full global fruition. This chart, extending out to the year 2050, done by the Congressional Budget Office, is a likely underestimation of where our federal debt levels are headed in the coming decades. The Federal Reserve Chairman Jerome Powell had the following statement worth highlighting this week.
To start with public debt and monetary policy. So I just would say, first of all, the U.S. is not on a sustainable path at the federal government level in the simple sense that the debt is growing substantially faster than the economy, and that means by definition it's unsustainable. That's not to say that the level of debt is unsustainable, and it's not unsustainable. It's far from unsustainable. And so I think we're a long, long way from fiscal dominance in the United States if we ever get to that place. And it certainly is not a factor that we consider in any way at this time. So high public debt in no way impacts monetary policy now. We are squarely focused on serving the public through our new framework to achieve maximum employment and stable prices.
Fiscal dominance occurs when a national debt has reached levels such that a nation is unable to pay it down with taxes and requires monetary policy support in order to stay solvent. Quick note, we're there already. In such a situation, it is difficult to control inflation because raising interest rates can make it impossible for the government to pay its debt. Raising interest rates in the presence of an extremely high government debt can cause markets to doubt the stability of the government, resulting in a collapsing currency and increased inflation due to factors such as higher import costs. Fiscal dominance puts an economy at risk of severe problems such as hyperinflation and complete collapse of normal economic activity. Now, there is nothing in this definition about how fiscal dominance can be avoided with direct monetization, or perhaps so long as one still maintains the dominant fiat currency of the world, utilizes yield curve control along the way, and suppresses real interest rates, while also rigging inflation and unemployment data, and somehow still dominating the world in most price discovery markets. Also not talked about is how we're on the cusp of losing economic dominance to over 2.5 billion people who tend to stack gold and silver increasingly as they get wealthier. Hey there, this is James Anderson on behalf of SDBullion.com. This is your week's complimentary SD Bullion market update. If you're not already, be sure to subscribe to our channel, and of course, obliterate that like button today. Tell this AlgoBot video platform that you enjoy our content. Another week of up then down spot price action for silver and gold as we head into this Monday's thinly traded Martin Luther King Day holiday. Note that the spot gold price currently sits just below its 200-day moving average. Typically during gold bullion bull markets outside of global financial crises, that is typically a solid time frame to be adding to bullish and long positions. Fresh out of the gate in 2021, big winners from last year like lumber, gold, and silver are down, now nearly halfway through this month, while many soft commodities and energy prices have been ramping as we begin the year 2021. For example, see this rising one-year price chart for corn and soybean meal, both of which are used to feed cattle and human beings. Last July 2020 on this channel, we discussed how a coming short squeeze on gold might result and not merely a silver but also perhaps even a gold bullion shortage worldwide. COMEX gold deliveries last year were record-setting, so much so that also in July of 2020, COMEX literally had to change the bullion bar hallmarks or brands which are allowed to be used for good delivery. Similar story in silver COMEX deliveries last year, again escalating to new all-time high levels. Now even supposed enemies of our state, nations such as China, Russia, and even Turkey, are allowed to pump their gold and silver bullion bar hallmarks as good delivery bars in our still price discovery dominant gold and silver derivative markets. This week gold prices in Shanghai, China are at last again back at a premium, so perhaps we will see more gold buying from the east as opposed to record gold buying from the west last year. Turning to Indian rupee prices for gold and silver to begin 2021, if you want to see a real-world example of how poor man's gold operates when the gold price chart gets away from the average man on the street, look no further than physical silver and gold buying in India. We are only a couple good silver trading days away from a new record rupee price for silver and a likely price breakout, which should lead to increased demand for physical silver imports into India. During the 2010s, there were many years in which India took over 200 million ounces of physical silver imports in a calendar year alone, and Indian farmers don't often fall for ETFs or leveraged derivatives over directly physically owning their silver over there. Report this past week by the Silver Institute forecasts that automobiles, especially growing demand for electronic vehicles, will increase silver industrial demand in the coming decade. Citing nearly 100 million ounces of silver demand per year by 2025 for car manufacturing, a near doubling from this demand segment alone. Seen here are but a fraction of silver's input uses in new automobile manufacturing. Remember back to the start of this week's update where governments are being encouraged to spend on items like infrastructure, and thus increasing solar demand will also be coming from both China, the USA, and likely the EU as the decade unfolds. Based on how 2020 went and 2021 is beginning, it's reasonable to bet that these two increasing silver demand factors will have to compete with increasing silver store of value investment demand ongoing. In a market of less than 1 billion new troy ounces every year, there are a lot of old and new players coming in, likely that will quickly escalate the ask price of physical silver bullion worldwide. As more trillions by fiat get spent and set forth into the global economy ahead, silver and gold values remain poised to ramp in the years about to unfold. Prudently position yourselves accordingly. And as always, take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.